What's up, everyone? Welcome to my corner of the internet. I'm your host, Ryan Kramer, and this is Crossover Commerce, presented by Ping Pong Payments, the leading global payments provider helping sellers keep more of their hard-earned money. Hello, and welcome back to another episode of Crossover Commerce. I'm your host, Ryan Kramer, and this is my corner of the internet where I bring the best and brightest in the Amazon and e-commerce space. Before we get started on today's special episode, I want to go ahead and just give a quick shout out to our presenting sponsor, Ping Pong Payments. Ping Pong Payments is helping sellers keep more of their hard-earned money by sending and receiving funds internationally through the technology that they've and partnerships that they have established, whether it be sending money to different suppliers, manufacturers, distributors, VAs, even just international businesses in general. If you're a B2B business or an entrepreneur that's trying to save money, time, and effort, and putting more margins back to your bottom line, check out Ping Pong Payments. It's free to sign up to use. All you have to do is just go to usa.pingpongx.com/podcast to get access to all of our past episodes, plus signing up for free today. It's really effective and really easy to use to make your business more profitable, which is what we're going to be talking about today. In the teaser, this is episode 195. We're trucking along. If you're a fan of the podcast, you know that we go live on Facebook, LinkedIn, YouTube, and Twitter, and that you can ask your questions for myself or our guest on today's stream of our podcast. But we're going closer to 200. We'll be celebrating that next Thursday. So a week from today, mark that on your calendar, more details to come. But today is really special because I have two gentlemen who've put their minds, their money, and all their research and data points together to look at the space that everyone loves talking about. That's the aggregator space. Yes, that's right. We're talking about, once again, here on this podcast, the space that keeps on raising funds. Even today, we'll even talking about just the news that broke earlier a few hours ago in terms of what it looks like for the Amazon and e-commerce space. So without further ado, the data report that they put out, wanted to make sure that we talk about that today and go a little bit more in detail on the podcast today. So without further ado, I want to bring on two Crossover Commerce from Global Wide Advisors, Joe Hogg and Rob Salmon. Guys, welcome to Crossover Commerce today.
Thank you. Appreciate you having us.
So, yeah.
Awesome. Well, wanted to go ahead and just give for people who are not familiar with Global Wide Advisors, we of course have Chris, but both of you are other entities both in the the research as well as the executive director space. So maybe Joe, for you first, maybe introduce us to introduce yourself to the audience and maybe what you do over at Global Wide Advisors and kick it from there.
Sure. So I'm a managing partner at Global Wide Advisors, and for the folks that don't know who we are, we're a lower middle market investment bank focused on the space, focused on helping people with the people that are in the consumer space do transactions. And a lot of the work that we do is with M&A. We're strictly sell side. We help a lot of Amazon sellers sell their companies. We also help people raise money as well. So that's pretty much our role. I've been in banking, capital markets, M&A my entire life for the most part. I started out of school, so it's about 30 years in the making. We originally got started as a different entity, as Providium Group and Providium Advisors, where we were really just taking core investment banking expertise down market to the lower middle market space. We found that there were just a lot of smaller companies that just really needed that core investment banking expertise, structured transaction expertise. And about 2 years ago, a lot of people were coming to us that were digitally native. They were selling strictly off of Amazon or some combination of Amazon and website, maybe a little bit of brick and mortar. And we recognized the need to focus exclusively on this deal flow because it was becoming so prolific with respect to what we were doing. So that was the genesis of Global Wired Advisors. And, the timing was ideal, obviously, because just as we were getting going, the pandemic hit, and that's obviously led to a transformation in e-commerce. So it's been quite busy. The deal flow we were looking at on the Providium side of the house slowed down because most of that was, more traditional. And we began focusing our attention almost exclusively on the digitally native deal flow that we work with today in Global Wired. So that's a little bit about us and about Global Wired. Rob, if you want to give Ryan and the audience your background.
Thanks, Joe. So I came from a institutional equity research background. I'd spent the better part of the past 2 decades at Wolf Research, before that Deutsche Bank, and was looking at kind of the huge growth that we were seeing from small and medium-sized businesses who are moving their goods on UPS, on FedEx. And this is a market which I'm absolutely fascinated by, and I'm really excited to spearhead the research effort over here at Global Wired. And our first report that I'm sure we'll be discussing quite a bit, and it is actually the topic du jour, given the $500 million raise that we saw this morning, are the aggregators. And we are looking at everything within the e-commerce space, and we're going to be putting out a lot more research. And I'm excited to help sellers, help institutional investors get their hands around this just really exciting space.
Absolutely. It's a market that there's a lot of opportunity, a lot of growth, whether it be as brands, as SaaS companies, but also as just service providers in general. But you guys put out a really intriguing report, and that's why I reached out to see if we could talk and go through some of the numbers. Numbers don't lie. Numbers are factual. They're something that's not an opinionated matter, but they tell a story of where you are as a snapshot, right? So that's why I wanted to look at today. And as Rob alluded to earlier, if you're listening or watching this, of what do you mean what happened today? Well, just want to add to the stream kind of a little bit of a nugget. If you're not watching the news and you're busy running your e-commerce business, which is a good thing, hopefully you're being successful. There's a great piece in Marketplace Pulse that keeps up to date on this, as well as just, hey, having a Google alert out of Seller X. There, as you can see in the snapshot that I took right there, the screen grab of now becomes a $1 billion entity, and we've had them on the podcast before. They raised a cool $500 million as of today. That was announced. Another big one where you might think, where am I hearing $500 million? It seems to be a very popular number. Heyday, about less than a month ago, also raised about $555 million to scale their D2C businesses. So again, just to date, in just 2021 alone, if you're thinking, man, it seems pretty consistent, you're right. There's about $1 billion every single month that's being raised across multiple aggregators in the space. And this will be a slide that we'll reference later on in the show, just in terms of numbers, but people are keeping score at home. And I say keeping score, we have a lovely slide here that just shows where people are currently today from our friends over at Marketplace Pulse. Of 2 entities are pretty close to, or 3 entities are close to $1 billion plus, but you have quite a collection of people in terms of the top, I'm going to call this the top 60 or so companies that are raising funds. Again, anywhere from $3.4 billion to $20 billion. That being said, gentlemen, you did some deep diving. You did a little look behind the numbers. You talked to these individuals. Where do we starting from here? First of all, what was the genesis and the point of this report? Is it for yourself, or is it something to educate in the space itself?
Well, that's exactly right. It was really designed to educate the space. And what we've found in being active in the space over the last 2 to 3 years is that there really isn't a great deal of rigorous analytical work being done. And we felt that was kind of a piece missing. On the institutional side, it's very prolific. A very rigorous analytical angle, is applied pretty much to most business decisions, in particular large business decisions. So we felt that this was something that just needed to be applied to the space, and that's really where we're coming from with respect to building out research at Global Wired Advisors. And this is our first report, our first thematic. We'll be coming out with a lot more, but clearly the topic du jour for most 3P sellers is aggregators, and what aggregators are doing, where the industry is headed, what are some of the things they are struggling with, where do we see valuations going as a result of involvement of aggregators in the space. So we felt it would be useful to put all that together in a fairly rigorous report and and provide it to people that were interested. And
Absolutely.
I guess that's where it's come from.
Yeah, and for people who might not know where the report is, again, we've put a link in the comment section. So if you're watching us on Facebook, LinkedIn, or YouTube, or Twitter, again, you can download the report. I'm going to point directly to your guys' website, globalwireadvisors.com, and it's in the research section. Fantastic resource to go to. Just putting your name and information. I think it's just the email address. But I have downloaded it. I've already looked through it, as mentioned before. And we're going to be sharing some of the findings that you guys did, if that's okay with you. We'll just go right into it and kind of break it down in the capacity of which you presented. So you said more, Joe. Is this an access to all of that list of aggregators? Of how many of those people are you researching? Is it something that they're open and willing to give this information, or is this something that you maybe have to pull teeth and kind of put your own spin upon it as well?
Yeah, there's a little bit of that. We had an opportunity to talk to a number of different people in the space, and we triangulated a bit ourselves as well. The report is really, I guess, an accumulation of what we learned in talking to people, in again, triangulating around topics where full disclosure would be a little bit tough. Also including what we see in the space from the sell side. And, we feel that it's a pretty representative depiction of kind of where aggregators are today. So
gotcha. So the report was published on, I want to say, November 15th. So again, a snapshot on November 15th. This is as of a few weeks ago. So for people in the space, we're going to just walk through. Let me zoom out a little bit so we can all keep a holistic view on everything. So
Ryan, it's amazing in terms of the capital raised subsequent to the report. An incremental 1.7 billion has been raised by aggregators. There's just
more reports should be published. It sounds like if you're in the financial world, every new report, there needs to be another $1 billion that's injected into space. But I think it's also important to note that a lot of this money gets skewed into what the top, I would say 10, I'm just going to call it 10 businesses that are raising funds. Again, going back to that snapshot I showed earlier, $1 billion at once was just raised by Thrasio alone. But there's so many different businesses of $50 million here, $100 million there, massive amounts of money being injected into space. Does this report go under why this is happening now? Like, why is this the right time to be doing all this?
It does. That's really the conclusion of the report. And the amount of money that's flowing into the space is flowing there for a reason, right? The investors, mostly venture capital, that are aggressively moving on this opportunity, see a significant payoff. They see a significant payoff primarily in the form of an eventual public securities transaction. And today, most really all aggregators are effectively marking their portfolios to model, because we don't really have much of a public mark to market proxy, really. Eventually, though, we believe that an aggregator is going to get over the fence, so to speak, is going to be able to pull off a public securities transactions, go public effectively via IPO, and you're going to see a significant increase in value. And we refer to that in the report as the prize. And we feel that most aggregators are really driving toward this goal of acquiring 3P sellers, building portfolios, building revenue streams, and eventually effectively getting into the public securities domain and having a consumer products good multiple applied to what they've built, which will see, again, a significant jump in valuation, because you'd be going from 5, 6 multiple today, basically acquisition multiple, to 15 or 20. So it will be quite lucrative. And then once that takes place, once we do see an aggregator eventually pull off this particular trade, we will have a proxy to mark everyone else to market. We will have a multiple to track. We will have effectively a stock price to track, and the rest of the space will see an uptick in valuation, right? And then that in turn will lead to you create somewhat of a virtuous cycle. That in turn will lead to more money flowing into the space, right? That'll lead to probably more acquisitions, and that'll lead to probably more public deals, given the success of the first one. So we believe that is the primary reason that aggregators are really raising as much money as they're raising as quickly as they're raising it, because this this lightning bolt is eventually going to strike, and once it does, it's it's going to reorder how people think about CPG in general. It's going to reorder how people think about Amazon and the 3P seller universe in general. I think it's going to be quite an event, actually, and we're probably not that far away. It's probably a 2022 event where we do see an aggregator go public in some fashion.
Absolutely. Well, and we know, at least it's been reported that there's been close to happening in terms of Thrasio have been doing it, and they've held back or either delayed it for a number of reasons. Again, publicly, they're not going to disclose it. So with that being said, a lot of things I hear that unpack there, and a lot of people that are talking about, and I've said multiple times, that this is the first wave. Like, people think that this is a lot of money being poured in, which it is. $12 billion is not something to shy away from. But in the space, because it's so open, it's green, and it's now being shown love, I should say. You're telling me that this is the first wave. What does the second wave look like in this capacity? Maybe Rob, can you paint a picture for us of when we know we're in that second wave, or are we still riding this like first wave, if you will, of the first institutional money coming in?
I mean, taking a step back, we are now seeing brands develop on digital platforms. Historically, you came to market and CPG companies would aggregate several of these individual brands into a larger conglomerate, purchasing companies that developed a product that was really unique. And we're seeing sellers have incredible success on Amazon. And when I think about just how big the retail market is in aggregate, $12 billion, $13 billion, it's nothing in terms of the capital that's been raised. And Joe was alluding to earlier about this opportunity of coming to market and being a publicly traded company. There is also just the benefits of growing a firm in size, and your valuation will increase from that 5 to 6 to a traditional private equity multiple is like 10 times EBITDA. So aggregators who are successful, and I'm going to use that term very, very loosely, because today we're seeing aggregators invest in buying these digitally native brands, but tomorrow it might be private equity who is serving that same role of purchasing multiple online native consumer product brands.
Right. So in this report, I guess the best place, it's an extensive report, and I want to make sure that we focus on it. It's a 21-page report. Where do we need to start? Where's the best place that people, if you're a brand, a seller, need to just start in going through it? Is there a page or is there an exhibit? Again, I think I heard the talk with you guys and Stephen Pope of, it feels like a court document that we're trying to make a case for somebody to be on the hook or off the hook here. But you have so many different awesome exhibits and examples here. Where do we start?
Well, let's start at the beginning.
Sure. It's always been told. It's always best to start at the beginning, right? So
close to the beginning.
Maybe, yeah, exactly.
Yeah, maybe page 3. Page 3 is probably is a good.
And that spot. First chart really says it all. Where do consumers start buying? It's on the Amazon platform. It's incredible how many customers start their search of what they want to buy on the Amazon platform, and as a result, it creates a really nice virtuous cycle, and is why sellers want to be starting their business on Amazon.
Yeah, and that's a good point. You know, if you look at Exhibit 3, insofar as GMV on Amazon relative to the next closest channel, Shopify, it's a pretty big gap, and you know it's a pretty big gap for a reason, really. Amazon has made scaling a young brand, a new brand, quite easy. The tools that you have through Amazon are historic in nature with respect to being able to build, launch, build an online brand and scale an online brand using FBA, using standardized advertising, PPC, you can probably, this is probably the fastest in history that you can grow a consumer products company. So the Amazon platform, by its very nature, has created the obviously created the aggregator opportunity. But this is really a good chart that shows the importance of Amazon, the dominance of Amazon, insofar as the innovation that they've brought to the marketplace. And based on what we have seen, it's really going to be a difficult gap to close for Shopify, eBay, Walmart, just because of where Amazon is headed. Amazon has recognized that being a service company is really more profitable than being essentially a consumer goods company selling directly to consumers via, say, the 1P model. The the service side of the house, fulfilled by Amazon side of the house, is really the future of the company by our estimation. They are quickly evolving into less of a product company and more of a service company, whether it's through the FBA platform or through AWS. So that trend is going to continue, and as it continues, we believe that gap probably grows as they continue to focus more on on 3P sellers and a little bit less on their own stuff. Now, that doesn't mean they won't again look to optimize the cost of PPC or FBA. We're always going to be dealing with the algorithms designed to maximize Amazon's profits, but I think that in general it's going to get even easier. Recently we ran into a lot of inventory constraints with respect to Amazon's ability to hold product and move product, but given the investments that they've made over the course of the last year, they've almost doubled, I think more than doubled fulfillment capacity. So
right, they more than doubled.
Yeah, so that's astounding when you think about how big Amazon already was, prior to making those investments. It's even more astounding when you realize that they did that during the pandemic, when we had a shortage of labor, we had a shortage of building materials, we had a slowdown in lockdowns and everything else. They effectively doubled the size of the company. And again, that was done primarily to keep up with growth in in the 3P side of the house. So that's an important chart. That gap is quite a commanding position given where the company is today and given where the company is headed. And there's a lot of talk about how that gap is going to be closed and the things that Walmart is doing and the focus on DTC away from Amazon and Shopify. But I think that the gap probably, at least in the short run, grows a little bit more. Absolutely. So that would be the first thing I would focus on. Go ahead, Ryan.
Well, I was going to say,
I guess just to piggyback on what Joe just said, if you look at Exhibit 9, the gross merchandise value that is sold on Amazon went from 3% of 3P sellers when this company was founded to north of 60% today. And that growth is something that we think the third-party sellers are going to continue to outpace the first-party piece of Amazon, which kind of fills that services side of the business. But the reality is sellers want to be there because of how quickly they can start up. A lot of sellers can go from idea to actual product on the marketplace in under 6 weeks. I mean, some of the data that came out of Marketplace Pulse is absolutely staggering, of how little capital is invested as well as speed to market that a seller can affect their business.
Right. There's a couple things that I think you both you harped on that I wanted to kind of unpack a little bit. Is the introduction to the space, again, the bump that e-commerce saw across the board. I think a lot of people are coming down off the high we saw numbers from Cyber Monday and Black Friday. And although most reporting data will say across the board numbers are down, but where numbers were trending before 2020 happened versus where we are today, again, the bump was so significant. But if you follow the line and trajectory of where it was in growth, 15% year over year, plus or minus or so, that we're still on e-commerce is still on pace for that traditional growth happenings, just that huge influx because, again, no one was in retail stores. They weren't waiting in line. Services were not open. A lot of that money shifted from the market as a whole and went into a small operation. I say small in conjunction of all of retail shopping, went into what was still operating, and that was e-commerce. So again, even though numbers might be down, I continuously tell people, do not fret across the board. All there be shipping logistics issues, all sorts of other issues, still on trend to where we were our trajectory was going before COVID-19. So is that a cause and a pause for concern that all of this swell of aggregation and businesses are growing and brands are being acquired on this sort of inflated, I would say, if you're looking at the number and then there is that bump, everyone was selling at that peak and that bump and looking at numbers from there when they should have been looking at before and after that bump. Does that make sense?
It does, sure. So let's walk through that. So I think it's important for people to keep in mind what the global economy has been through over the course of the last 2 years. And we all know, I guess at a personal level, how challenging it's been. But to see a shift in consumer spending from services, which in the U.S. is 2/3 of the economy, to almost exclusively goods is extremely abnormal, and it is extremely disruptive, as we're seeing play out in supply chains today still. So you can't lock people down, shift consumer spending patterns to the extent that we've seen, and then begin to normalize them and not expect continued disruptions through e-com, through brick and mortar, through supply chains, et cetera. So that's really what we're seeing now, hopefully on the back end of the pandemic, although we believe that Omicron is going to play a little bit more of a significant part than people are ascribing to it now with respect to everything. But when we do get on the back end of the pandemic and we continue to see these normalizations take place, you're going to continue to see bullwhip type of disruptions playing through the economy, through e-commerce, through personal consumption, retail sales in general, that are difficult, or once in a lifetime events, difficult to manage through. So that's the context that you need to keep. And it's easy to look at your year-over-year performance and say, wow, my year-over-year performance isn't what it should be. I'm not growing the way, say, an aggregator would be expecting me to grow. However, the market has been through convulsions with respect to spending patterns. And when you normalize P&L to reflect basically those broader trends, a lot of people are doing fine. A lot of people are actually doing better than expected. So that's really the first thing to keep in mind, is that we're still kind of going through that normalization process. The next thing is, you're right, e-commerce is growing at 15+% a year. And I would say that, despite things normalizing back to trend, there is a whole new demographic now that's been introduced to online shopping that is not going to go away. I mean, we forced people that were a little bit older, that were a little bit more traditional perhaps in their spending patterns, to shop on Amazon, to shop online, and a lot of that is going to be sticky. It's going to stay. So I think that that's something that is probably going to, for a while, allow us to grow a little bit above pre-pandemic trend. So that could suggest something a little bit higher than 15% yearly. And with respect to aggregators investing in the space and seeing this type of volatility in the amount of money that's been raised, they are raising money for a longer term play, really. They see existing trends. Again, if you normalize out what we saw over the last 2 years, you're still seeing 15+ a year in growth, and that's fantastic. And you're still going to, I think, continue to see e-commerce grow insofar as market share of total retail sales as well. So I think that it's difficult to take the last 2 years, which unfortunately this industry is so new and the whole aggregator phenomenon is so new. It's difficult to take those 2 years and extrapolate any sort of new trend with confidence. I think it's probably better to just normalize back to where we were 2.5 years ago and just assume that we probably grow at that or slightly above.
Robbie, you want to say something? Yeah, not to that.
If we're looking at the data, e-commerce as a percentage of retail sales has actually declined. But I think the amazing thing is, despite comping those 40-50% growth rates a year ago, e-commerce is actually still growing high single digits on a year-over-year basis. So we are definitely seeing that trend of increased consumption. And the fact that it's declining as a percentage of the mix was really depressed when we look back a year ago because you couldn't go to stores. So the base is higher. So I think it makes sense that it's declining. And I think the fact that it is able to grow despite comping 40-50% up is incredible and speaks to the sustainability of the secular trend in e-commerce.
Absolutely. And speaking of numbers, does Global Wired Advisors expect the trends and valuations of brands to continue to rise, or do you guys expect and subject it to be more normalized in terms of flatten out at a certain multiple? Because right now it's trending at, I think it's doubled in the past year since it was. I think it's trending at 4 to 8% EBITDA instead of where it was in end of 2019, early 2020. I think it was 2 to 3x.
Yeah, we've seen over the last 2 years a pretty aggressive expansion in acquisition multiples, no doubt. And a lot of that was really due to a bit of a land rush as aggregators were just getting going and raising a lot of money. We saw really a stampede into the space where brands were acquired quite rapidly. And the point that we make in the report is that a lot of those brands were acquired using debt. They were levered, and a lot of aggregator portfolios, when things started to normalize and kind of return to trend, found themselves with less attractive investments than they had originally hoped for, right? So
you're telling me not everything they acquire is sunshine and rainbows, right? There's some stinkers in there.
Exactly. Right. Just like 3P sellers are struggling a little bit. They might be struggling a little bit more because they applied leverage. They used debt to make a lot of acquisitions. So insofar now as with respect to multiples and where we see them going forward, I think that aggregators are going to be a bit more discriminating. They're going to be a bit pickier, with respect to what they acquire. I think that, because of kind of the land rush and a little bit of the hangover following the land rush, you're going to see a little bit more, let's just call it rigor, applied to each acquisition and in due diligence ahead of each acquisition, which is normal. I think also probably what you're going to see for the first half of 2022 is companies that did see year-over-year growth and that were able to basically perform better than trend. I think they're going to continue to enjoy multiples that are, again, in that range that you mentioned. I think that's going to be quite easy. I think for folks that are seeing year-over-year declines, really kind of following what we refer to as the beta of the market in general, just kind of following where broader e-commerce, has been trending. I think they're going to see some multiple compression. I think that's natural. I think that, there is going to be the need to discount some of the growth that these firms saw during the pandemic. And I think that, that kind of next tier down is going to be a little bit more challenging, insofar as getting deals done. But then when we get in the second half of next year, I think that you start seeing year-over-year performance improve, and I think that also year-over-year comps improve as well. So then you start seeing kind of that second tier, that might be under a little bit of multiple compression. You start trending back to where that top tier is getting done in the first part of the year. Because again, the Seller X-rays shows you that there will be no slowdown in the amount of money coming into the space. So that's how we see valuation kind of high level and kind of how it evolving, I guess, next year.
Absolutely. I think the thing to also think about too, and I'm assuming you would agree with this, is that where brands are looking to acquire businesses, what that mix looks like has also evolved over time. I remember hearing we only want Amazon brands, we only want operated through Amazon, albeit makes sense. That's where it makes sense to functionally operate through. There's that mix that's starting to skew towards CPG, being on Walmart, having a little bit more mix of there's more an establishment of a brand in terms of what that looks like. We saw deals come through in terms of comes with fulfillment centers or has their own warehousing. So it has all these different mixes as part of it. And I believe the one with Seller X today included a brand acquisition as part of that raise, is being able to go after those higher shelf brands of operating on a global scale, of having all these additional assets. Does the mix start to become more apparent of what they're shooting for, more of the higher, keep building and shooting for those top 500 brands on Amazon? Or are we going to start to see more chances being taken in terms of like infrastructure, factories, in terms of maybe product mix, or just niching down within a category itself? Are we going to start to see this breaking apart instead of an agnostic approach?
Yeah, so I think those are all good questions, all good points. The desire to continue to find economies of scale is going to continue for aggregators, and that really was the original thesis when aggregators started raising money and entered the space. The thesis was, hey, we're going to acquire as many brands as we can. We're going to try to find related brands. We're going to try to push together manufacturing sources, distribution sources, and again, squeeze economies of scale out of similar products. I think a lot of that wasn't really realized. I think, again, in the land rush phase of the last 2.5 years, most aggregators ended up with just a mishmash of different brands that really, when you looked at them, you couldn't really find a lot of common threads where you could see economies of scale insofar as manufacturing or product development or anything like that. So I think that is going to be a renewed push going forward. I think that you are, with scale, you're definitely going to see, more folks in the space looking to vertically integrate into the distribution business, into manufacturing, probably into onshored manufacturing, given what is happening in Asia, particularly in the Taiwan Strait. I think, you're going to see more interest in having things that are closer to home with respect to being able to make things. So yeah, I think you're going to see the build out of a lot of, frankly, a lot of the bigger ideas that kind of got aggregators started over the course of the last year and a half. I think now with billions of dollars of extra funding, you're probably going to see a lot more execution with respect to some of those ideas.
Maybe I'm going to ask Rob, and I think this would be a good question for you. What was the most shocking statistic that you came across that kind of like drew everything together for you? Was it a thesis that you had before going into it, and a number or numbers really pulled it all together for you? What was that? What was that light bulb moment for you when putting all this together?
Yeah, I think there's a lot in here. For me, it was just how big.
It's not light reading, guys. Like I'm telling you, like I'm going back. Like I have to put it down, think about it, have a cup of coffee, really think about it, and then come back to it. This is an in-depth look. Lots of graphs, lots of data points, which I appreciate. So I'm just going to put that out there for people like, oh, let me just look at the summary and think about it. No, this is in-depth knowledge. So continue with that, anyways.
And appreciate those thoughts there. It's just how how well the third-party sellers have done on the Amazon platform, to me, going from 3% to 62, that is really just staggering. And the ease at which a good idea can become a brand that can resonate with the consumer is why we think that this phenomenon has actually got a lot of legs. When I think about things that I'm personally buying, there is a founder-run business can just capture the consumer in a way that some bigger companies struggle to. And so I think we're going to see strategic buyers buying some assets that are created on Amazon. And that could be the traditional brands that we buy at a Walmart, at a Target. It also will be aggregators who are going to purchase them. And there will be a bifurcation of aggregators who are successful at really scaling brands relative to others who are unsuccessful at selling the brands, but very good at search engine optimization. But that isn't a sustainable business model, in my opinion. You've got to create something that resonates and people want to go back and recommend and buy, as opposed to paying the most amount of money to get purchases up, because that's not what any brand owner wants. They want to see their brand scale and scale very nicely, whether it's in their hands or if they sell it to a third party.
Is there going to be a less of going after those top 1 to 2 selling on Amazon and more of maybe an adverse risk of shooting for the middle? And I say middle of, there's more meat on the bones. If I acquire the number 1 selling pillow brand on Amazon for 5 years running, it's pretty consistent, right? But year over year, I can't take that to another level, right? There's only one way to go. That's down. If it's ranked consistently at number 1 and I'm putting my hat on growth, there's nothing you can do besides just driving more people to buy that. And that's not economies of scale. That is just simply saying there's more risk in that capacity than there is of opportunity. So do people look at a product or
diversify where you're selling, right?
Exactly.
If you take it D2C or you take it into because
retail,
of your relationships into Walmart, you could meaningfully scale that up. And that was one of the things we tried to capture in our hypothetical look at a brand, is how do you kind of accelerate growth? Is it D2C? Is it kind of a new channel in retail? And those are things which I think really successful aggregators are going to use in their arsenal and meaningfully expand where they're selling the product.
Right. I'm just going to call BS on anyone who thinks that they can just only grow on Amazon. Again, there is growth happening on Amazon. But again, when you acquire the top selling pet brand or a top selling yoga pants or top selling kitchen gadget, you can only take it so far unless you draw more traffic and point it to that direction to be acquired on it. Or like you said, Rob, take it to a different vertical, whether that be retail shelves, storefronts, or direct to consumer, and then you're driving outside traffic to it. I will be the first I'll be on that soapbox forever and saying, listen, that you're going to look at that risk reward tolerance, right? But going back to my original point, are you going to look at a great product, doesn't have the capital, doesn't have just the scalability, or it's just so young right now, where they're going to say, I'm going to catch it before it hits that rocket ship and it lights its fuel and it's going to be going sky high. That way we ride it and we can capture all of that sales instead of buying it from the top and let's just keep it there. Does that make sense? Like there's 2 models there. Let's keep it at the top and ride that and try to drive it in different directions instead of maybe taking a chance on a really great product or brand that actually did the right thing. They just don't have the capital resources in the background and take it to the next level. And that's where the aggregation model can really take something off.
I think you summarized it really well there, Ryan. Because if you do find that brand that just needs the incremental capital, the scalability is huge. And that is sometimes why it just makes a lot of sense for a third-party seller to monetize their business, because they've taken it as far as they can based on the capital that they have, as well as the time they want to allocate to running the business.
Will you see an incubation stage maybe evolve from the aggregation model? Because there's a lot of different ways I've seen this, right? If you're a fan of sports, you become a farm system, right? You acquire all these different ecosystems. You have data at your disposal. You have a logistics system at your disposal, and you capture those individuals or brands when they're young and they're infant before you can really reap the benefits. And then all of a sudden, then you make that investment to them. And then that it's almost like taking them to the major leagues, right? It's like, now you're ready. Like, you're primed, you're 18 years old, you have a fireball, like you have a rocket arm, all these different things. And now we're going to introduce you to the market, and then boom, take off. Do you see that more of an incubation stage maybe that's going to emerge from these models, or is that too early to tell?
Well, I think what you're seeing with Amazon, kind of going back to the first diagram that we talked through, is the ability to launch and scale a brand is unprecedented. We've never seen it before in history. And the flip side of that is we have a lot of brands. You're seeing an immense acceleration in the number of brands that are coming to market primarily through the Amazon sales channel. And these brand life cycles are now much shorter than they were in the past. A brand life cycle 10, 15 years ago could last a decade or longer. You think Nike, Adidas. Right now, those life cycles are very compressed. And I think that Amazon is a key brand incubator, but really I think the way aggregators are viewing brand acquisition is similar to how venture capital views investments. You make a lot of investments, and then 1, 2, or 3 hit big. And when you have a brand that finds real permanence and is able to grow outside of the Amazon ecosystem, potentially into brick and mortar, obviously Shopify, Walmart, then you extend that brand life cycle. Then you're seeing the brand life cycle that would normally apply get extended tremendously, and you have again another leg of exponential growth. So I think that is really the kind of the long-term idea behind brand acquisition. And you're right. I think there are going to be a lot of brands that do get big that are not going to be scalable beyond the Amazon ecosystem, but there are going to be some that that just view Amazon as really the launch pad. And I think that if you're building a consumer products company, a multi-brand consumer products company, that's probably the view that you have, is that you're going to eventually end up with 2 or 3 anchor brands that have been the result of years of investment in a multitude of shorter cycled brands that just didn't stick. And I think that's really what we're going to see. I think that ultimately, if you want the tape forward, say 5 years, you're going to see aggregators that have clearly become publicly traded companies. They are going to probably have a lot of different brands, a lot of, let's call them shorter cycle brands, and they're going to have 2 or 3 or 4 or 5 big hitters that everyone is going to recognize, I think, and they're going to be selling predominantly online, obviously.
Right.
Ryan, in your example, that number one product that's selling on Amazon, and maybe it's plateaued out, but you're getting some really good cash flow from that product. And it's the $1 million question is, what do you do with that cash flow? You could invest it and incubate, kind of like you had alluded to, or you could take that cash and you could continue buying more brands and kind of get those to skyrocket. So right. I think aggregators are going to take different tacks, and ultimately at some point in the future, we will have more publicly available data to judge kind of what the aggregator performance is. And we will see a bifurcation of some who are really successful at building brands, at using that cash flow very wisely and prudently and scaling further, and others who are not as successful. And clearly there was a soft patch, which we alluded to over the summer, where there was definitely pain in the space, and pain is always amplified by leverage, just the way leverage enhances a return during an up market. If it's tough, you might be burning cash. And that definitely does not feel good.
No, I was going to say, I think like kind of in the last couple of minutes I have you gentlemen on today, with the future outlook, it almost feels like, man, if this was not in a pandemic era, or maybe this is a result of it, would we see this condensed nature of which we know that some of people are going to miss their payments back to their financial investors. What I mean by that is maybe it's my products were stuck in the ports, or maybe hey, we just bought one brand that is just not going to provide the returns we thought it would, and we have to somehow either consolidate or we have to sell off brands. Is that the model that you think, or like that's what's coming in the next iteration of this, is either more people who are going to start gobbling up these brands again? We showed a massive list of brands that, or companies that can acquire brands or are planning to do that. There's going to be a consolidation, we're assuming, correct, of hey, they just can't sustain growth or at the rate at which they took money. What's kind of that next future outlook if we had to put it on our futuristic hats and kind of tell the future, which we're all really good at, right? We're all going to be 100% correct. If we had to guess in that nature, is it a lot? Is it a little bit? We're going to see, like you had said, Rob, 5 major players in the space after 5 years, or maybe it's people kind of like under the radar and we're just going to say consistent. What does that look like?
Well, I think short term you're going to see some consolidation in the space. I think that, given the normalization that we've talked about during the podcast, and the likelihood that a lot of acquisitions were levered by aggregators, you're going to see a little bit of a cleanup phase, we think, where some aggregators are probably going to have to merge with others. You're probably going to see some trading of portfolio positions among aggregators. I think it's important to remember that the backdrop is still quite bullish. I think that, going forward, money, as we've seen with the Seller X capital raise, is going to continue to flood into the space, irrespective of normalization. And again, this is a point that we make in the report. Any consolidation or any near-term trouble that, say, smaller aggregators were to run into, we think is just going to be a bump in the road going forward. And with respect to the long-term view, what does the landscape look like? Well, I think what you're going to see in, let's use 5 years as a time horizon, I think you're going to see several aggregators that have gone public by that point in time, maybe more, and you're going to see a lot of firms right behind them that are in the process of working to go public. And the beautiful thing about getting over the wall, so to speak, with a public securities transaction first, or in that first group, is that when you see an uptick in valuation, you're at a point now where you can affect acquisitions of other aggregators that haven't quite made it to the wall or up the wall yet, right? And I think you're going to see some of that as well, where the people that are able to to get public, realize that increase in value that we spoke of, are going to have tremendous ability to look back into the space and and make acquisitions of other aggregators, which is going to lead to consolidation, I think. But probably, again, in 5 years, what you're going to see is 3 or 4 or 5 maybe that are publicly traded, and a whole raft of other companies that are on the same runway looking to affect the same trade, I think. There's probably going to be no slowdown in the amount of money that's raised. Going back to a question that you asked earlier, what was something that struck you as is particularly interesting or relevant when you were putting the report together? What struck me was the amount of money that's been raised over 2 years as quickly to affect really one trade. If you think about it, and we refer to this as Amazon platform arbitrage, which is buying 3P sellers, affecting change given internal economies of scale, and seeing a likely significant uptick in top line and profitability. And to raise that much money as quickly as aggregators have raised to in essence affect that trade is kind of fascinating, really. If you compare that raise to, say, the hedge fund industry when it got started back in the 90s, it is very similar with respect to how quickly money is pouring in. But with the case of hedge funds, there were, the investment landscape was much more diverse. There were so many different things that hedge funds in the early days were doing, whereas here there's effectively one trade, right? That's being contemplated. And I think there are obviously different iterations of that same trade, and there's a lot more of that one trade to do. But that's what struck me as kind of interesting. And we point out in the report too that there's a huge thing that isn't similar, and that's the fact that hedge funds were not looking to go public. That here is the principal reason for this, for this opportunity, for this trade, if you will, is to build the next publicly traded consumer products company that is focused almost exclusively on Amazon or DTC.
Everyone wants a slice of the pie, and I know that you're at the top of the hour, but I wanted to give a final thought if you have one, but then also where can people learn more information? Because I know you guys are working on another research that's supposed to be coming out in December. I was promised December or mid-December, so I'm looking at my clock in the next couple of weeks. Is that when we're expecting more data, more reports coming out, or are we going to wait until after into 2022, Rob?
We want to give everyone an early Christmas present. So
very nice.
We're hard at work for the next product, and that's one of the beauties about research. There's always a next thing to do. While you and Joe were talking there, I was actually running in my model, our aggregator capital raise model, and both of your comments kind of struck me. And we've basically already seen this, where the top 5 aggregators have raised about 55% of the capital. The top 10 have raised 70% of the capital of that $13 billion that's been raised to date. And the other thing which I was thinking about is a typical CPG company, all right? If I'm thinking about a Smucker's, a Procter & Gamble, they've got a product which has been doing really well, but they realize they've taken that product as far as it can go. So they sell the product, whether it's coffee, tea, a bag of chips, and someone else purchases it. That is very common in CPG and in retail. So to me, it makes total sense that aggregators would end up doing the same thing with the brands, which either they've taken it to where their skill set can be, or it just wasn't a good fit. And they'd rather kind of either monetize their gains or cut their losses and redeploy that capital. Makes sense.
Yeah, there's a lot to be known. But gentlemen, best place for people to find more information, obviously that globalwireadvisors.com/research, I'm assuming. So I'll have to keep that in my tab bar to make sure I'm always getting pinged when new stuff is coming. But is there any other last thoughts, Joe, you wanted to impart on the audience today before the holidays?
Sure. So our next research piece is going to be on supply chains, and that'll be coming out here in the next week or two. And we encourage everyone to check it out. I think you'll find that it is equally rigorous as the aggregator report, and we're going to throw in there some additional insights that we think are going to be particularly relevant for 3P sellers going into next year.
Amazing. Well, thank you so much both for sharing just your insights and time. Again, I know this is a lot of time equity that you're putting in the ability to find that data points. Obviously, it's going to help the seller community. It's going to help the business acquirer community, but also just helping the community grow itself in general. So I'm excited. I love this upward trajectory. Another one likes it when everything's going down. It was kind of a bummer to see Black Friday in Q4, or I should say Black Friday, Cyber Monday numbers go down. I would say a percentage or 2 points across the board. That's a lot of money, but not as bad as what I would have thought. But I appreciate you both hopping on today. Now, I would consider friends of the show. I feel like I'm going to have everyone in the office just stop by my podcast and hop on and give some insights. So if we have more people, you're going to have to email them to me over a couple of days. Yeah. Awesome. Well, I appreciate you both hopping. Have a great night, and we'll look for that next report next time.
That sounds good. Thanks for having us on, Ryan.
Thank you both. Thank you, Rob and Joe, again, for both of you guys for hopping on Crossover Commerce. We appreciate you guys stopping in my corner of the internet to just go over some research numbers. Again, I think data is super important in terms of making sure you understand where the business of economies of scale are going. It means if you're going to exit your business potentially, if you're going to grow your business, where you can do that, make yourself more profitable when you do exit, all those things matter. So that being said, I'm Ryan Kermit. This is Crossover Commerce, episode 195. Make sure you tune in tomorrow. We'll have another episode coming your way in my corner of the internet. Make sure you guys take care.